Alright, what's up everyone? So today I got a super quick video basically talking about what are gas or transaction fees as they pertain to different blockchain networks. So when you hear the term like transaction fee, you can sort of visualize it as what it would be like to fill up a car at the gas station. So essentially you have your total cost, which is what it costs to fill up your car, but your car takes a fixed number of gallons. So every car is going to have a fixed number of gallons it can fit, but this gas price is going to be variable. That's going to be a function of the oil market and supply and demand, what the gas station sets. A whole bunch of different factors affect the gas price. For a blockchain network, it's actually really no different. So gas is a term that is predominantly used by Ethereum to describe how much Ethereum something costs, but gas itself is just a unit. It's pretty much a unitless unit. You could think of it as like a quantity, really. It's just a quantity. So this gas term is going to be totally fixed for any given smart contract. So smart contracts can have a lot of different functions in them. So now we're just talking about Ethereum. So you can have DeFi smart contracts that are really long. There's a lot of code in them, so those will cost more gas. And then you can have the most simple smart contract of all on Ethereum, which is literally just sending Ether from one address to another. So that's the most simple transaction you can do on Ethereum, pretty much. So that amount is always going to be fixed depending on the smart contract. But you have this gas price, and this gas price is going to be driven by the market. So this is the thing that you want to be watching out for when, say, you are executing certain transactions on Ethereum or another network. You want to make sure that that gas price is as low as possible, so you don't have to pay as much to execute that transaction. And then you have the final cost, which is the product of the gas and the gas price, which is the total transaction fee. So on MetaMask, that would be what you see as sort of like the tax or the fee just to get your transaction out, posted to the network. So really it's directly correlated to the terms of this gas price. It's directly correlated to the number of transactions being concurrently pushed to the ledger at any given time. So on days when, on Ethereum, for example, when say the DeFi space is really heating up and you have a lot of people waking up and trying to partake in some certain DeFi activities that are all getting pushed to Ethereum, then the Ethereum ledger gets clogged up with all these different people trying to send transactions at the same time, and algorithmically, just built into the code of Ethereum, the price will skyrocket. The market rate for gas is much higher to post that transaction. So when you have a lot of transactions being posted, the gas price is going to shoot up. So it's sort of a similar thing with Bitcoin. Here, sort of, you can see this is just the total value of US dollars of transaction fees paid to miners. So this is sort of what keeps miners in business. So a lot of miners that are executing their consensus nodes across a giant blockchain network, the reason why they do it is because there's an economic incentive to perform those transactions. So they get fees in the form of Bitcoin just to mine a block. These are just in the proof of work realm. This is how miners make money, through transaction fees mostly. So as you can see here, this is past few months. Definitely had a big spike in late October, and it kind of went down a bit. And then in terms of just Bitcoin miner revenue for the past year, which is a function mostly of transaction fees paid to miners, also various block rewards, you can sort of see that it takes this shape here. So this is from blockchain.com, one of their metrics things. So it's just definitely interesting to look at this, and I think it's a really good idea to keep an eye out on charts like these and make sure that they're stable, because a lot of the times you can sort of explain why prices are acting the way that they are of different crypto tokens. You can sort of gain a lot of insight by looking at these miner revenue charts. So then we can look at Bitcoin miner revenue for the last 3 years. And we can definitely see, towards the hype of early 2018, it was at an all-time high. But then as more miners come onto the network, and potentially as Bitcoin price is fluctuating and dropping, things like that, it leaves a chart that has a downtrend here. So the more miners that come onto a network, that those transaction rewards have to get distributed to more miners. So then individual miner revenue will be declining. So that could be an explanation for why this chart has a downtrend here. Now moving on to Ethereum. Ethereum has this cool site called ETH Gas Station, and it will give you sort of you have 3 different brackets for Ethereum gas prices. You have Trader, which is post your transaction to the front of the queue as fast as possible to execute, say, like a DeFi trade, for example, or like a crypto token swap, things like that. Then you have Fast, and you have a standard transaction where you're not in a rush to send it. That'll be cheaper. So this price will definitely fluctuate every second of every day. This thing is always fluctuating. But as you'll see here, that number basically in, I guess it was September, October of this year, there was a major hype in the DeFi space where everyone was sort of transacting on Ethereum with these different DeFi tokens, things like that. And the transactions were totally clogged up. So just sending a transaction on Ethereum, just to send a single transaction, was costing people on average almost $10, which is insane. And then that's just an average transaction. So if you have sort of like a beefier transaction, like say you're on Uniswap or something, and you are trying to swap a token for another token, or you're trying to participate in a liquidity pool, and you have to post a transaction to enter that liquidity pool, it would cost like 30, 40, $50 maybe, depending on the type of contract you were executing. So the prices were insane back then and very unsustainable. That's a large driver for moving over to ETH 2.0 so that these transaction fees can be reduced. So after that sort of hypey phase, definitely things dropped off a lot, but they're still relatively high, a lot higher than they should be for transactions on Ethereum. So we can also look at Ethereum miner revenue here. It's just sort of another interesting chart to look at. Over time, definitely, since those transaction fees were so high back in early October, late September, miners were just totally raking it in. It was really insane. And then it dropped off, but miner revenue definitely been doing well lately, especially as Ethereum transactions have been rising really steadily over the past, basically, I think this is an all-time chart here, so a lot of people are on Ethereum right now, and there's a lot of things to do on Ethereum compared to Bitcoin. So the number of transactions occurring on the Ethereum blockchain are really high and steadily increasing. So definitely something to be aware of on this chart here. And this is a coin metrics chart here. So yeah, that's sort of just the basic gist of how to understand what transaction fees are when we're trying to do various things on different blockchains. So some blockchains are more focused on reducing those transaction fees, so that's sort of definitely a big component of what attracts people to certain blockchains, and especially in terms of businesses and miner revenue, all these factors come together and are just really important to be aware of. So I also have a Discord channel here, so feel free to join that and talk and hang out. And yeah, thanks for watching.